My name is Marcus Doloff. I help run a program called the MIT Startup Exchange, which is part of MIT Corporate Relations. And our mission is to connect corporations, Global 1000 companies, with MIT startups. And we do that to the tune of several hundreds, if not thousands, of introductions every year. We have 1,700 startups from across all departments at MIT, employing all technologies, solving use cases across many different industries, and including energy. And then on the other side, via the Industrial Liaison Program, we have 270 approximately corporate members, again from across all industries, across all geographies. And today for this panel, we're going to talk about two topics broadly. We're going to talk about data, analytics, and digital and energy, what the current challenges are, what the future looks like. And then we're also going to talk about big company and startup collaboration, something that we deal with every day. And together with me, I have a number of panelists here. So I have Jean Dolgin from Clima-Cell. They're working on improving weather prediction. And then Thomas Laurent, CEO and founder of Excelos. They're developing digital twins for large assets, heavy industry assets. And then Hudson from Line Vision. They are improving or helping companies assess, monitor power lines. And then finally, we have Carl Cranfeld, head of corporate development, Americas for Shell. And the way we're going to run this panel is that we're going to have each of the startups do lightning talks, so talk for about 4 or 5 minutes to explain the technology they're employing, the problems they're solving, and some of the value they're creating. And this is to give you a glimpse of some of the value that is being created using data and analytics in energy. And after that, we'll go into a more thorough discussion of the two topics. So with that, we're going to go to Excelos. Thomas, please.
Yeah, thank you, Marcus. Thank you for inviting Excelos. So this is a story of a great technology in the lab at MIT, going all the way to unlocking the economic potential of digital twins. In 2011, we win the largest Desprende grant at MIT. Today we have offices on all continents and then investment from some of the large players in the industry. At the core, we build the world's fastest and most advanced engineering simulation technology. We have the claim to the largest predictive digital twin on the planet. That's an asset that's the size of actually several aircraft carriers. It's a multi-billion-dollar asset, which is with very large liabilities. So the operators and the best-in-class operators really want to know what is at stake with the asset, and it's operating, of course, in very harsh operating conditions. Now, our mission is actually to democratize this type of technology for many more type of assets. If we look at data by itself, it's too low in predictive power to be used. Data is nothing without meaning and structure, and that's what a physics-based model does in terms of augmenting predictive power up to 90%. So what we've done is we took the technology that every engineer uses at the design stage for mechanical asset, and that's called finite element analysis, but it's very constrained. You can do a couple of compressor blades, a joint in a platform. It's hard to do an entire model. And in operations, what you need, if you want to have an operations-ready FEA, which has high predictive power, you need speed, you need it to be coupled with sensors, and you need a better workflow. Now, this is where all the hard research at MIT went into 100 academic publications and so on before we could really unlock all this over the course of 10 years and have this type of technology that can really capture FEA on entire asset, condition-based models of entire assets. It's 1,000 times faster than the original FEA, and it's due to the mathematics at the core. Now, in terms of value for the operators, we have several value frames that can come from that. Usually, we start on one value frame with an operator, and in the course of the engagement, we'll see several of the other value frames coming up. I'll give an example with asset life extension. Asset life extension for an offshore platform, that's a big value frame. And with Shell, you can see the legacy technology on the left. We're going to publish several times this year on this. With the legacy technology, it's very coarse beam models with stress concentration factors. And actually, there's a lot of unwanted conservatism that's embedded into that engineering workflow. When we move everything to 3D, we use the same fatigue curve, we use industry standards, but we're able to show that whereas with the legacy technologies, there's only a few joints that would actually qualify for a 20-year life extension, with a 3D technology, you actually get nearly all of the joints qualifying for the life extension. And actually, if you add the sensors and if you calibrate the soil pile interactions of the platform, you literally get all of the joints qualifying, and you can take this to the regulator and so on. So that's the type of value we're unlocking, just one value frame for operators. We bring this also to wind. We're going to present this with Acciona on the third floor in 1 hour. Here's the product at the core, what's happening. You have a physics-based model. It's very detailed. And you're able to solve this in a few seconds and do thousands of solves and get an aggregated view of what is at risk in the asset. Each of the solves is really very accurate. This is FEA of 100 million degrees of freedom model that runs in 10 seconds. It's science fiction compared to what people know with FEA. And you can run thousands of those solves. So that's the idea. What we really love about the technology as a team is that it will be very important, we feel, for floating offshore and for fixed offshore wind farms. So we're working a lot on that. It's a technology that can truly run at planetary scale, which is essentially what's needed for the energy transition. Thank you.
Yes, Gene Dolgan from Climacell. A couple of quick words on who we are as a company. So we are a Series B startup. We raised our second round just in October. About 100 folks spread across Boston, Tel Aviv, and Boulder. And we are part of the Startup Exchange that Marcus runs. We've generated customers across a number of segments, including aviation, utilities, sports and other venues, and we have a couple investors across National Grid, JetBlue, and Ford. Now, let's talk about the problem with weather. So weather is something that affects every aspect of the global economy. We've seen numbers up to $2.1 trillion annual variation due to weather variability. That's storms, that's flooding, and a bunch of other effects. Yet despite all of that work and all the cost, there still isn't enough good data out in the world to actually make decisions based on weather. So what's the core problem? First of all, observations are sparse. This is New York City. There's several tens of millions of people that move across the city and the tri-state area every single day, and there's only 3 publicly available weather stations for anyone that's trying to understand what the current conditions and current weather is in that environment. 2, models that leverage those weather observations are coarse. What does that mean? So the U.S. National Weather Service, for example, has a global forecasting system that generates forecasts up to several days out at a 28 kilometer by 28 kilometer grid resolution. That means for a city the size of Boston, you'll get 1 parameter for temperature, you'll get 1 parameter for wind, you might get 1 parameter for solar radiation and other things. That's just not good enough or granular enough to actually make decisions on several days out, let alone several hours out. So what do we do? For us, we've turned that equation upside down. We said we're not going to go out and deploy more weather stations. We're not going to deploy more hardware. We're going to go out in the world and find things that are already connected, that are already weather sensitive, and use the data coming off those devices to generate weather knowledge. So whether it's cellular networks, satellite networks, commercial airplane sensors, smart city sensors, connected vehicles, mobile devices, we collect data off all of those things and understand the impact of weather at a much, much more granular level than anyone else doing this work. How does that look? This is probably the easiest example to digest. So on your left is the city of Mumbai with 1 public weather station at the airport. On the right is our virtual sensor network. So we have something like 5,000 disparate links that are reading the weather in real time across the city of Mumbai. It lets us get a level of granularity and accuracy that no one else does, and know exactly how the weather is changing, basically block by block throughout the city. The second thing we do, we talked about models being bad, so we run bespoke, really, really high resolution weather models up to several weeks out that actually let people that care about it understand the impact and the future state of weather at a degree that they can actually make decisions about it. So again, on the left-hand side is the best model you'll be able to find in the US, which is the NOAA-HER model. It's a 3-kilometer resolution model. We can run the same thing at a degree of hundreds of meters. So for places like wind farms, for solar irradiance, for other things that are weather affected and highly concerned with future weather, we can actually provide information that they can make decisions on. That enables us to go into a whole bunch of other areas, whether it's air quality, flood modeling, particularly for utilities and others in the power sector. Fire risk is a big concern. Once you have better information and you have better models, you can actually start to develop things, derivative products that are highly useful and highly leverageable for decision making and for operations and other factors. With the energy domain, there's obviously a lot of relevance. So for renewables forecasting, maintenance, other operations, whether it's wind and solar, weather is the number one factor that affects variability globally. Transmission optimization, distribution optimization, again, weather, and I'm sure you'll hear it from our friends at Line Vision. Weather is extremely impactful, and it's a very important thing to understand. Crew and asset safety, demand supply forecasting, energy trading, finance, and ultimately outage prediction are all critically affected by weather day by day, week by week, and it's something that we feel that we can solve and help the industry move forward.
Good to see everyone. My name is Hudson Gilmer with Line Vision. I was actually a student here at MIT 13 years ago, and it's great to be back. At that time, we were really just in the formative years of getting the Energy Club on its feet. Ernie Moniz, who went on to become our Secretary of Energy, was our faculty chair, and it's just amazing to see what students have put together here. So Line Vision, who are we? We're a local startup. More technically, it's a spin-out based in Greentown Labs up in Somerville. And our focus is unleashing additional capacity and the true potential of the transmission grid through advanced sensors and analytics. So we raised our Series A back in December, and the problem that we're solving is the growing disconnect between generation and transmission. So if you go back maybe 10 or 20 years ago, generation was largely central power plants that were dispatchable by utilities or system operators. And the grid that we have today was largely built decades ago around that model, around one-way delivery of power from large central power plants. As everyone in this room knows, we've seen a dramatic change, and we'll see that continue in terms of the generation mix. It's becoming more renewable, it's becoming more variable, and yet we still have a static transmission grid that we're carrying that generation over. So what does that mean? In the US alone, we're seeing about $4 billion a year in congestion cost. So this is the cost that's borne by the ratepayers and by generally renewable generation owners in either higher prices because more expensive generation and dirtier generation is required to be dispatched, or curtailment, which means generally renewable power gets shut down and wasted. And so this is not just a US problem. This is a global problem in terms of just the assets. There's about $6 trillion in transmission assets worldwide. So Line Vision is focused on solving that problem through a combination of sensors and analytics. We provide a platform which is a combination of non-contact hardware that mounts on a transmission tower and advanced analytics. So what this does, it allows the utility for the first time to unlock additional capacity on existing lines through what's called dynamic line ratings. And we probably don't have time to go into detail on the principles of that. We will be at the technology showcase in about an hour and can go into as much detail as anyone's interested. But that's kind of the first benefit. We use a combination of sensors, a patented EMF sensor, electromagnetic field sensor, that gives us visibility on all the electrical properties of a line. And we combine that with a scanning optical sensor that can measure precisely the physical position of those conductors. And then we bring all that data into our cloud and run some advanced analytics to calculate line ratings, calculate forecasted ratings, detect anomalies, and monitor asset health, and deliver all that to our customers through a secure web interface or a data feed. So what are the benefits to the utilities? The first is increased capacity. So with dynamic line ratings, we can unlock 15 to 40% additional capacity on an existing line and actually improve the reliability of that line. And that allows greater renewable integration, less curtailment, and more resilience on the existing grid. Secondly, we can enable greater situational awareness for the utility, allowing them to see the actual condition of their lines for the first time, detect risks either to asset health or to public safety. And you only have to think about the wildfires and the bankruptcy of Pacific Gas and Electric that's been in the headlines recently. And we would argue that's a direct result of operating unmonitored power lines. And third, somewhat similar to Axelos, we can do asset health monitoring. So we reconstruct a digital twin of the transmission line and can monitor the position of those conductors, detect deterioration in the tensile strength of those conductors, detect all the forces that can cause aging of those conductors, such as operating at elevated temperatures, such as vibration, and annealing, and give the utility for the first time the ability to do condition-based asset management rather than just operating to failure or replacement at end of life. So just one example, and again, I won't go into too much detail of how we're using analytics. We not only provide a real-time forecast of, or a real-time dynamic rating of the line, we can also forecast that rating for up to 48 hours in advance. And this kind of ties into also why weather is so important. So we can, for a defined confidence interval, use forecasted weather along with the learning of our training of historical data to tell a utility with confidence what the rating will be for the next hour, for the next 4 hours, for the next 48 hours. And just in terms of status, again, we raised a Series A. Initially, we had been somewhat resource constrained, so we have about a half a dozen utilities in the U.S. who are clients of ours, and now we're expanding into asset health monitoring and into building a network of partners overseas. Thank you.
Thank you, Hudson. All right, Carl, you don't get any slides, but I'm hoping you can tell us a little bit about the company that has more retail locations than Starbucks.
That is true. So first of all, I do work for Shell. Pleasure to be here today. Just a little initial disclaimer here. Everything you hear today is expressing my own opinions, clearly influenced about my day job at Shell, but I'm in no way, shape, or form officially representing Shell today. If you do trade on this information, don't blame me if you screw up, right? So Royal Dutch Shell is a very large, obviously, international oil company. We are active in more than 70 countries around the world. We do our traditional business model, extracting hydrocarbons out of the ground, refining them, distributing to one of our 44,000 retail locations. Which, yes, there are 19,000 Starbucks in the world, so we have twice the retail presence of Starbucks. We also happen to be the world's largest Coca-Cola distributor, and we sell more coffee than Starbucks, and it's the most profitable product that we sell. So that is our core business, right? However, we also have moved in and said that we think it's very important, both from a societal aspect, to create an energy company that's more than hydrocarbons, which involves the power chain. the value chain. We have officially stated we want to be the world's largest power company, famously a couple of weeks ago. What that means is that the gentleman who said that also mentioned that implies a business of a size somewhere with $10 billion a year EBITDA. And if you do that math in reverse, you end up with a very large power company in the front end. So what does that actually look like? It's a power company that has both generation, but also a strong customer presence. Again, we feel very strongly that we have a good brand, and we have an ability to deliver to end customers a quality product with safety, reliability, and a high degree of satisfaction from the customer. So you can kind of map that out from the hydrocarbon world also into the power world. This is a business we call New Energies. Currently only been around for a few kind of 3 years, 4 years now. But as I say, we're rapidly on the plan to expand that in a not distant future. We are a large company, 400 billion of revenue a year, right? About 100,000 employees. But we have a spectrum of tools to interact with the entrepreneurial community, starting with something called Game Changer. It's almost like institutionalized angel capital, a few $100,000. And it's a way to kind of get early technologies into the energy sector. And we try to help provide both guidance and steer. And in the middle, we have something called Shell Ventures, which is a corporate venture arm. It's a traditional corporate venture arm measured both on financial return and strategic return. We have offices all around the world and investing about $3 to $7 million initial investment, kind of 10 to 15 over the lifespan. Take board seats, board observer seats, or neither, whatever is best for the entrepreneur in this specific situation. We can co-invest with every single other investor out there, except maybe one, another large oil company with a name that starts with an E. Everybody needs a boogeyman. That's kind of our boogeyman, right? That was definitely my own opinion, not an official Shell statement. And then on the other end, I currently head up corporate development for Americas for this New Energies business. That means that any kind of investments larger than $20 million, any kind of M&A or majority-like investments across solar, storage, wind, emerging business models, things transportation as a service, etc. And because digital is very fundamental to all the product offerings that we will have across this new market segment, anything related to digital. We have officially stated we're going to spend $1 to $2 billion a year, stepping up to $3 to $4 billion starting next year. So that's kind of what I do. And that's a little bit about Shell.
Perfect. Thank you. So as I was preparing for this panel and getting some questions lined up, I realized we have an Israeli, a Swiss, an American, 2 Swedes, and that could be the beginning of a great joke. But luckily for you, I'm not going to try that. Instead, I'm going to ask Hudson what he's been doing since he graduated. All right, so you've been in energy since graduation, and a lot of that has been spent in digital energy and analytics data. So could you tell us a little bit about the change you've seen since you graduated and where we are today?
Sure. So I graduated in 2006 and was fortunate enough to, I did an eLab project for those Sloanies that are in the audience here with Enernoc when they were pre-IPO. And Enernoc is a leading demand response provider who since has sold to an LX. So I don't have a history in old energy. It's really only new energy. But I went from there and joined a startup called EnvaPower that was doing, for the first time, predictive analytics for regional power markets. So we were replicating the way system operators are forecasting day ahead and real-time prices and providing that data to traders. One of the interesting things is that when we first built those models, renewables had no effect on the market. They were just kind of noise. They were price takers, and the plants that were setting margin were coal and gas plants. And we didn't even, yes, we modeled the wind, but we didn't have to model it precisely. And solar was not even kind of on the scene yet in terms of being a meaningful market driver. So obviously a lot has changed since then. Now we see the duck curve in California. We see negative pricing in a lot of wind-rich areas. And I think when you look at the levelized cost of energy of these technologies, renewables are driving the market, plain and simple. And that's really exciting. And I think the other observation is just the data that we as an industry now have at our disposal. And I think the three companies here, are representative of just the incredibly, exponentially greater granularity and accuracy of data that just didn't exist only 10 or 12 years ago.
Carl, from the perspective of a big company, how do you look at digital energy today, where we are?
Yes, digitalization of our industry is absolutely core, right? By the way, I would also add that on top of the renewables, which today are cost competitive without subsidies, right, on the traditional energy sector, it's also the fact that fracking changed fundamentally how we actually extract hydrocarbons, right? The great news, though, is that in reality, unless you're going to tell hundreds of millions of people in emerging markets that they can't have a TV, they can't have a scooter, and they can't have air conditioning, we need both the hydrocarbon economy and the renewable economy. We need both to satisfy the energy demand of the future, right? That's the beauty here. There's a lot of talk about kind of competition between the old and the new energy sectors, but in reality there's not, right? We need both to be successful, especially if you're going to leave some kind of a world with, a little bit less carbon than we walked into it behind. So from digitalization perspective, though, right, it's fascinating to me because the way in the old energy sector the things work, it's the same thing they've done for 100 years, right? And if anybody here ever saw like a seismic chart, that sounds really cool, kind of underground radar finding where hydrocarbons are. It's like a fuzzy picture with like the gray lines. You have no idea what's down there, right? And we're actually quite astonishingly poor of finding out where resources are. And on the other end, right, on the demand side, you kind of think about it like, well, you guys have 44,000 retail stations. You got to understand exactly what people, kind of want to buy and how they want to buy it. We don't. We have 17 loyalty programs in the US alone. And unless you're kind enough to swipe that loyalty card, I have no idea who pulls up to the retail station, right? Now shifting over to the renewable world, where, first of all, until we have grid-level storage at cost-competitive prices, it would be core for someone like us entering into the market. If we're going to deliver a superior product to the end customer, we have to figure out a way to understand the customer, but B, understand the entire kind of physics on the other end. How can we generate primarily, quite frankly, renewable power, insert it into the grid, and then deliver it with quality and reliability and safety to the other end? The only way to do that is completely basically sensorize the entire value chain and store all that variables, 724 in every single location, and then extract a better kind of value proposition and ecosystem across the whole range. So I think digitalization is fundamental both in the old energy sector and 100% in the new one. I would make this a blatant argument that on the kind of renewable new energy side, if you're not digitally enabled, you're going to get crushed. Like you have to start thinking digital from the day number one you start a company in that area. Is that strong enough?
Perfect. Gene, ClimateCell operates across a number of industries, not just energy. What are you seeing in other industries? How does energy compare to other industries? Are there blueprints that can be borrowed from transportation, from, manufacturing, et cetera?
Sure. So first of all, I want to make one correction. I'm not Israeli, but I spend a lot of time there.
Sorry.
But we can add it to the joke. So in a previous life, I spent a lot of time in consulting and in venture capital, so I've been around a lot of industries, even outside of ClimateCell. I have to say, energy is probably one of the most complex industries I've seen wholesale, hands down. The other sort of key issue here is it is absolutely mission critical. You need to deliver energy every minute, every second of every day, 24/7, forever. So the stakes are much higher here, and the reticence to make sort of breaking changes into systems, whether they're digital systems or they're hardware or whatever else, makes the bar a lot more difficult to overcome. What we've seen work in other industries is really identifying small portions of an organization that can really champion sort of a digital approach, a data-oriented approach, that have done the hard work, and I think Carl was referring to it, of really understanding how to be digital, of really building the infrastructure to start making analytics-oriented decisions and tackling and approaching those people first. If we walk into an old traditional utility and sit with a C-suite executive and say, here, take our hyper-local weather, and here's a whole stream of it, go to town, they won't know what to do with it. They don't know how to operate on it. But if we can find the people in the organization that are trying to optimize a certain function or trying to do better, let's say trading or hedging activity on some of the renewable assets, and they already are digitally enabled, then those people know how to move and how to act very quickly.
Mm-hmm. Thomas, from your perspective, what are some of the top challenges you're seeing when you start working with partners across energy?
It's
in terms of digital transformation.
Yeah, it's industry alignment. So it's essentially industry alignment in the sense that where we work, the largest predictive digital twin I showed, it only makes sense if you have the class society that recognizes the digital twin. If the insurance broker then is active in actually going to the insurers and lowering the insurance premiums. And we're doing all that work, actually. So we do the work with the largest class societies. They have introduced 2 digital twin class last year for certain type of offshore assets. We have operators who want to be part and shift from the offshore class to the digital twin class. We do the work with the largest broker in the industry insurance for energy. Of more than 50% of the market is owned by that broker, of actually going not only to the insurers to explain that technology and also bring the premiums down, but also go to the operators and explain how to lower the risk with that technology. So it's back to industry alignment. As Jen said, it's a huge industry, and in that sense, it takes time. Yeah.
Mm-hmm. Carl, from the inside of a large company, what else would you add to that? It sounds like it's about people, or other top challenges you see?
I mean, the hardcore recommendation would be actually twofold. Don't go after the big companies first, right? Go after the small emerging kind of entrants in the marketplace, unless they happen to be a large company who is willing to kind of entertain. And obviously we are a new entrant into the power sector, right? So I would highly recommend to work us heavily on the power side. In our core business, it's a little bit more challenging, right? And then you have to find a way to work with us. And I think one core way to do that is to work with people like I mentioned before, Shell Ventures, their corporate venture arm. That is a key function of what they do, right? Is to help you navigate the big beast. Because as a large company, we can basically bear hug a startup to death, right? We can throw unlimited amounts of resources when it comes to safety protocols and legal and treasury and finance policies and whatever it is, right? So the corporate venture arm really help you kind of navigate some of that things and make it easier. Mm-hmm. But I do think that the only other advice I would give, and I spent 15 years doing kind of financial venture before I joined the corporate world, is to, even though it's great to have that name brand customer, sometimes it just takes such a long time. So at least maybe do a pilot with them to get the brand name, and then go after the real customers, or the smaller, emerging, more kind of aggressive players, right?
Okay. So just an open question for anyone here. Let's get more specific around the challenges around handling data, working with data. Name something. Name, top 2 challenges in terms of data. Gene.
So in the weather space, and I was actually speaking with a friend earlier about this, the biggest challenge is consistency, actually, in terms of understanding weather. So if you're an analyst role and you're looking at historical weather data, it's in one format. If you're looking at current understandings and weather data off weather stations, it's something else. If it's something in the future, it's a third format altogether. And if you're, we're speaking a little bit about digitization, if you're trying to build a machine learning model, let's say, on historical data, you've trained it on one thing, and all of a sudden you apply something else altogether, and the thing doesn't work. Yeah. And it's frustrating, and it's painful, and it causes a lot of friction. So just consistency and availability of data broadly defined, and I would argue, again, in our space, a little bit of standardization across historical all the way through to forecast data.
Yeah. So whoever,
I'll just share our specific perspective. We sell to utilities, and utilities, understandably, are very focused on security of their data. Concerned about cyber attacks, and so to really earn the right to serve those customers, that's a major focus for us. So we need to demonstrate our procedures for data security, demonstrate that we're not exposing a new attack surface to them in terms of cyber attacks, and part of it is also, they need some of them are more ready to embrace a cloud-based infrastructure, and we believe we've got a great story around security through the cloud, but others maybe take a more traditional approach and really want it on-prem, which is a little tougher for us in terms of just scalability of our business.
So maybe I would ask, I mean, from our standpoint, right, there's kind of three things. Number one, we have an astonishing amount of data, right? 30 million customers a day go to those 44,000 retail locations. That's only one piece of our business, right? We have an just amazing mass of data. Number two, we own that data, right? The days of a vendor coming to us and saying, give us all your data and we'll give you some cool results are long gone. We're happy to lend you the data for you to run your algorithms, get your algorithms to get better, but we own it, right? So you can make your product better, but we own the data. We're not going to give it to you ever, right? And the third thing is we do actually have a lot of personal identifiable records. Again, 30 million customer transactions a day, where I both know what you bought and what location you bought it at, right? So we have to have a whole different level of understanding of the security aspect of just that piece of it. Also, we're active in more than 70 countries, so we also have to figuring out that the data we collect in one country, we may not be able to use in a different one, et cetera, right? Sometimes have to be locally stored, or sometimes we can move around to different data centers. It gets super complex, incredibly rapid. And again, I'm a huge believer in analytics and data. So what I mentioned before, we want to kind of sensorize the entire value chain. This problem is only going to get exponentially worse.
Yeah,
Thomas?
so we have consistency, access, ownership. I think ownership is the one where we see the most challenge on the commercial side. I think Shell wish they own the data, but the reality, we don't want to own the data, but the reality is your manufacturers may own the data. When you have a compressor, it may not be yours. And what we see there is that it's a bit like the internet in 1997 when it comes to the business models that exist around the data in the energy industry. Like in 1997, we probably hesitated to drop our credit card number on the internet. And right now, people don't know. Everybody wants to sell a digital twin, but nobody knows who's going to own that data. It's a bit where we are. So I think the business model are not aligned yet around ownership of data, and that's creating some unnecessary friction. Yeah.
I'm going to share a small anecdote from our experience in the utility sector. So we were engaged with a client in California that landed something let's call it a 100-page contract on our desk, probably 50 pages of which were around data security and data privacy, and they screamed and yelled that they couldn't share the transmission infrastructure with us because it would be a security violation. We ended up finding that information publicly available online from the California Public Utilities Commission, and we're able to end run that whole process, but it goes to show you how much friction there is within some of these organizations that makes it difficult to sort of get to what is the logical end result, but you have to jump through a lot of hoops. So, to the extent some of those things can be cleared, or there's someone on the other side that can call things out and sort of help move them to the side, that absolutely makes the process a lot easier from a data perspective.
So that's actually a key point of how to work with a big company, right? Remember, the majority of people in a big company, they will get fired if something goes wrong. Very few of them get promoted if something goes right. So you have to find a person who is willing to kind of say, no, I get promoted if it works out well. Yeah. And he or she can then kind of guide you and take you to the next level, right? Don't get stuck with the people who only will find problems because they will get fired if it doesn't work out.
Yeah. It's the hug of death.
Yes, the bear hug of death.
Right. So one of the things I didn't hear you guys talk about was data transparency, meaning how do you know what the model is saying? Right, so it spits out a result, and 25%. Is that something you see, or do you need to start explaining the models? Or are you doing that already?
So I think we're probably in similar situations that we're using physics-based models, and we're also relying on industry standard IEEE standards. So I think there's not as much kind of fuzzy machine learning type stuff going on. It's really very clear how we get from A to B. So that's really not a major issue for us.
Got it.
So
Yep.
for us, that's changing though. I think 10 years ago, if you sold a product to us, our technical staff would like to see every single algorithm, break it apart in tiny particles and figure out exactly what happens. Because that's what we did with the old drill bits and everything else, right? We took it apart to understand exactly, to make sure it wouldn't break. However, we are rapidly getting more comfortable with the notion of machine learning and other things where the amount of data will make the algorithms better. It also implies that we're getting comfortable with the notion that, again, I mentioned before, you borrow our data, you make your algorithms better. The more people that actually lend you their data, the more rapidly your algorithms becomes better, which is better for us. And that's kind of a brand new concept for most people in the energy sector, right? That sharing kind of sensitive data with a vendor gets you better products because other of your competitors are also sharing similar kind of data. That is a brand new concept for us, right? But it's slowly getting kind of taking hold. Yeah. But it's a really hard concept for a lot of old timers to truly grasp. Saying, why am I giving this data to this little startup vendor, right? And wait a minute, they can use that to make a better product for a Conoco? It's like, yeah. That's good, right? That's really hard for a lot of people to grasp.
And just quickly to that point, so our model is that our clients, the utilities, own the data, but we reserve the right to aggregate and anonymize that data to make our product better. So that, I think, keeps us both comfortable.
Yeah. Sounds good. All right, so let's switch and talk a little bit more about collaboration between big companies and startups. What are some common challenges that you see? And these could be internal or external. You know, sometimes the startup, has to carry some of the blame. Sometimes the big company carries some of the blame.
No, never.
Typically, the big, yeah.
So I mean, I'm going to start, right? So I usually call it the hysteresis mismatch. Because what happens is that a small company aggressively want to get something done, right? And then the large company on the other side. So, for example, the large company says that, we think that, the accounting standards or the safety protocol you have is very important. So we'll send you a 148-page document that you need to fill out. Because clearly you have a compliance department of at least 12 or 15 people, right? And the startup goes like, wait a minute, I have a part-time CFO and she's also doing the compliance stuff on the side, right? I can't do this, right? On the other side, the small vendor goes to one of the assets out in the field, out in the Permian or up in Alaska or something, right? And they sell one little product to a gentleman in the field, right? A local general manager who may have a budget of millions of dollars they can spend on different products. They buy one license for $50,000. And the startup is super excited, like, whoa, we sold Shell. This is just copy and paste around the world. We're going to go public next week, right? Not realizing it's false traction. It's a local independent decision done in the field by a local kind of decision maker. In no way, shape, or form does that mean that the actual mothership has decided we're going to standardize on that solution, right? And that's two examples of kind of what I call this hysteresis mismatch, where both parties have to kind of adjust and understand how this works. We're used to dealing like large suppliers like an IBM or a Schlumberger. They have a big compliance department. So we need to figure out better to work with a small company. Same time as a small company, don't put all your eggs in one basket and saying, I sold one license to a gentleman, or a woman at some location in Dubai, and therefore we are golden, right? We're done. That's where I would start. I think that's the biggest problem.
So, in the audience, please raise your hand if you know the book, not necessarily read it, but Mastering the Complex Cell by Jeff Thaw. You heard of that? Okay, that's good news.
Hand.
That's two hands. That's good news to me because this is a book that the large legacy vendors really master, which is really to go and spec in their product into the buyers. So what I think entrepreneurs have to be really good at the beginning is to cull all the potential buyers, all the potential customers that get sold into. Because we cannot compete against a sales team of Dassault Systèmes. They're very good at selling very old technology. And we can't compete against that. We don't have 15 people in sales in the early days. And so we have to be able to find companies, and if you're a buyer, and if you want to be really innovative, you have to have that process. We have to be able to find companies that have their own buying process. They don't get sold into, they go and buy technology and innovation. And as an entrepreneur, I think that's one of the biggest things in the early days is to really be able to make the difference between the guys that get sold into and the guy that actively go and buy out. For example, Shell in the Game Changer program, they came to MIT with 20 people for 48 hours. They reviewed 15 different labs, companies, and so on, and they said, we want to work with you. That's a company that goes and buys innovation.
So kind of building on that point, I think the lesson for startups is that it's so important to have a development partner, to have a customer who will give you feedback and help you make your product better. Just focusing on the technology without actually having that feedback loop, you're irrelevant. So it's really kind of identifying that customer who is willing to invest the time, who believes in the direction that you're headed, and will give you that feedback. You know, we've had situations where utilities will have their R&D departments agree to do a pilot with us, but their R&D departments, you know, you could cynically call it window dressing. You know, they're detached from the real company, and so no one actually looks at the data that you're providing them. So what's critical to really kind of make sure you're gaining traction and delivering a product that actually works is finding that customer who you know, they may give you bad news, but it's great to get bad news. That's you know, so valuable to you in the early stages. So just finding that kind of partner who will give you the feedback early on.
And what are some of the filters you can apply to figure that out? Most people are not going to tell you they're going to be a bad partner, right? So
I think you can ask questions in the pilot to say, okay, what are the success criteria, right? And if we deliver on our side, where does it go from here? And if they haven't thought through those, you know, they're just spending R&D budget, right? You know, it's wasting your time.
You know, we ran a workshop in a conference. It was a room this big, and we basically said, "You guys, we're going to present you the technology for 3 minutes. Then you think about where it can bring value in your company at each table, and you report back to us." And we picked 5 tables. Well, it was a great workshop. It really worked really well. But I had a couple of tables where the guys told me, yeah, we don't think you should do that. You should explain us the stuff. We don't have to find out all that stuff. Well, I know I'm not selling to them. That's my filter, because those guys, they need to be explained A to Z by the vendors. I'm going to lose against a legacy vendor at that game. I need people who understand what they're looking for in terms of innovation in the early days of the company. You know, as we get to a team of 50 people in sales, sure, different. But today we're getting to 15 people, so we're in between. Yeah.
all right, maybe let's go to audience questions. I can't actually read the first one, so Gene, maybe you can read the first one there.
The role of AI in the energy sector.
Why are you laughing?
So, I guess I'll start.
Whoever wants to take it. Role of AI.
Well, I think as Carl was alluding to, you know, there's a general consensus that the end state is a fully censored, end-to-end and smart system. We obviously have a very long way to go to get there, but I think, you know, starting in the new energy sector, so to speak, is a fantastic opportunity, and also, you know, frankly, again, enabling large and available data sets for people to toy with and to build models around and to connect multiple disparate things together, potentially in non-obvious ways, is also critical.
Is AI the most transformational technology in energy, just like in a lot of other industries?
But it's awesome by the person to put AI in quotes, right? Because it's been around for a long time. So I think you need to kind of think about it. What it really is just an ability to see more, extract more business knowledge out of existing processes, right, or emerging processes. And I think it's absolutely fundamental. It's going to totally reform the energy sector as we know it, just like it's done in retail or financial services or advanced manufacturing, right? Quite frankly, in many ways, the energy sector is a little bit lagging behind. So I think it's going to be crucial.
You know, there was an article a couple months back about how most of the AI startups out in the world are actually people startups that claim to be AI. And I think the same applies everywhere else, right? We talk about AI, but it's actually a couple really good engineers or data scientists that are sort of at the forefront of putting together models, but at the end of the day, they're still doing the legwork. It's not a magical box that you can just dump everything in and get answers out of. So there's frameworks and things that need to be built to make it work.
But maybe to highlight how important we as Shell think it is, we actually have a center of excellence for analytics, which includes AI. And that's about 140 people in it today, sitting in London. So we built it out in the last couple of years. We think it's absolutely fundamental. Digitalization and AI in the broader sense, so machine learning and other ways to, again, enhance business processes, we think is absolutely fundamental. We think it will drive additional kind of $10 to $20 billion to our bottom line.
Let's go to the next question.
You want me to read it?
Yes, please.
So I can.
Where does IoT stand in solving the challenges of digital energy?
So I think it's back to Carl's point about just end-to-end sensors and analytics throughout the value chain. We look. My former company that we spun Line Vision out of is a company called Genscape that's deployed thousands of monitors on transmission lines, not just in the U.S. but worldwide, and you'd be shocked how low the utilization is on those lines, and so. There's a lot of opportunity for us to just get more out of our existing assets and improve reliability, improve public safety through deploying sensors. And I don't think it's different in energy than it is in transportation and a lot of other industries.
Just building on that and throwing in another buzzword, right? So people talk about blockchain. And for the energy sector, most people think the most impact of blockchain will be in kind of peer-to-peer trading or kind of distributed generation and kind of neighbors trading energy with each other. I think the most fundamental impact of blockchain will actually be in the IoT space. Because if you think about sensorizing the entire infrastructure, right, it's an incredibly security threat. Like if your shopping cart at Amazon gets a little error and it gets a wrong recommendation, you don't care, right? If you actually have an error happen in the sensorized infrastructure and the platform falls over or the whole power plant explodes, that's a real problem. So the security aspect becomes key. And utilizing blockchain is kind of a safety transmission layer to get all the different sensors to make sure that they get the right information and they actually fulfill the mission you tell them to do with the actuator is absolutely core. And there's a lot of IoT security startups who are basically trying to duct tape the enterprise model of security into the process domain. That's a really hard and complex and expensive way of doing it. Something like blockchain can fundamentally undo that and do it kind of, I would say, the right way. And that's really cool, right? So if you're a blockchain person, stop thinking about the kind of virtual currencies and think about the process infrastructure.
The one thing I would add, and Climacell is in part built on this, but there's billions of connected devices already out there. There's billions of things that are collecting data. The first technology that we leveraged to understand the weather was a piece of data that mobile network operators collected and literally threw away. They didn't have any use for it. We found a use for it. And I am 100% certain that if we sort of dig deep across whether it's consumer or industrial sectors or commercial sectors or anything else, we can find things that are already connected, that are already IoT, quote unquote, that can deliver value if properly harnessed, towards digital energy.
Yeah. I think we have time for maybe one more.
You want me to read that?
Yeah, please.
So as startups, how do you cope with or plan on coping with the long sales cycle of utilities? And I'll jump right in because we're selling to utilities. And when we talk to a lot of investors, a lot of them are scared away by the sales cycle of utilities. We were fortunate in that we had incubated the business for about 3.5 years within our former company and had started a lot of sales activity. But it is a reality. They're slow. I'd say the flip side of that is once you have a utility as a client, there's a lot of stickiness to that, and there's a lot of, it may sound pejorative, but a lot of herd mentality that they will respect decisions made by other utilities, and it can allow you to spread throughout the industry very quickly.
There's something happening in the industry that is an opportunity with respect to the long sales cycle because we do have to go through the energy transition. It's a race that we cannot afford to lose. And the companies in the energy space understand that and understand that if they don't turn the ship with a 20-year time horizon, they will be out of the game. And so with that race, the sales cycle are actually shortening to some extent. And it's all about positioning. So we just joined, for example, the World Energy Council as a partner because it's a mission-driven organization where we feel that the customers that are over there are actually in that race, full steam. Just today we were at Free Electron, which is a place for startups in the energy space, renewable, to actually help large companies, and they have a very strong process. And we finished first at Free Electron just today in Dublin. But there are places where the race is on, and if you join those places, you can shorten your sales cycle.
Two small additions to that. The first one is that I absolutely agree. A lot of innovation will come from small emerging vendors. It will not come from the traditional legacy vendors. And for people like Shell, we have an existing supply chain in our old business, but on the new side we don't. So we're much more open to talking to new vendors on that side, right? Because it makes perfect sense. The other thing is, as a startup, if you can be kind of not in line, your life is a lot easier, right? So a sense that a monitored power line, if their solution breaks, it doesn't take down the entire power grid, right? So it's smart to start with a solution where you bring a lot of value, but if you fail, you don't take the whole system down, which of course is kind of obvious, right? But if you lay those two together, you have the sales cycles are much shorter, and it's much easier to get into the market today than it was just 10 years ago.
Okay. I had one
Final comment,
So
and then we're done.
I'll make it simple. Go hang out on the unregulated side of these businesses because they're able to make decisions quickly. They're able to move much faster than the regulated side that has to go through a regulated RFP process often, which might take 18 months or longer.
All right. Thanks so much for sticking around and hearing us out. Please join me in thanking the panelists.
Great.